Starting April 1, 2025, major changes are coming to the taxation of partnership firms and LLPs in India. If you are a partner in a firm or an LLP, you need to be aware of these new rules to stay compliant and make the most of the benefits they offer. The Finance No. 2 Act 2024 has introduced two significant amendments, one related to an increase in the remuneration limit for partners and the other being the introduction of Section 194T, which mandates the deduction of TDS on payments made to partners. These changes will have a direct impact on how firms compensate their partners and manage their tax obligations. Let's start with the first change, the increase in limits for partner remuneration. Until now, the remuneration that a working partner could receive was capped at 150,000 rupees or 90% of book profit for the first 300,000 rupees of profits, and 60% for the remaining profit. But from April 1, 2025, this limit will be doubled. Now, for the first 600,000 rupees of book profit, partners can receive 300,000 rupees or 90% of the book profit, whichever is higher, while the limit for the remaining book profit remains at 60%. This means partners can now receive higher remuneration while keeping it tax deductible for the firm. This change is expected to benefit firms that wish to fairly compensate their partners for their contributions. However, firms must ensure they update their agreements and books accordingly to avoid tax complications later. The second and more critical change is the introduction of Section 194T, which makes TDS applicable on payments to partners. Until now, partnership firms and LLPs were not required to deduct TDS on payments made to their partners. But from April 1, 2025, this will change. Under the new rule, if the total payments to a partner exceed 20,000 rupees in a financial year, the entire amount, not just the amount exceeding 20,000 rupees, will attract a 10% TDS deduction. This applies to payments such as salary, commission, bonus, and even interest on capital. However, payments related to drawings or capital repayment will not be subject to TDS. This means that if a firm pays a partner a salary of 500,000 rupees, then 50,000 rupees will be deducted as TDS and deposited with the government. The deduction must be made either when the amount is credited to the partner's account or when it is paid, whichever is earlier. Another important point to note is that under Section 194T, partners will not be allowed to submit Form 15G or 15H to claim an exemption from TDS. Additionally, there is currently no provision under Section 197 for a lower deduction of TDS. So, firms must deduct the full 10% on eligible payments without any exceptions. For partners, the deducted TDS will be available as credit against their final income tax liability when they file their income tax return. If the tax deducted is more than their actual tax liability, the excess amount will be refunded after their return is processed. This TDS can also be adjusted against their advance tax liability, helping them in better tax planning. A common question that firms may have is whether TDS should be deducted monthly or annually. The answer depends on the nature of the payment. If a partner receives a fixed monthly salary, the firm must deduct TDS every month at the time of crediting the salary. However, for payments like interest on capital, which is usually calculated at the end of the financial year, TDS should be deducted when the interest is credited, typically in March. With these changes coming into effect from April 1, 2025, firms must take proactive steps to ensure compliance. The first step is to update their partnership agreements to reflect the new remuneration limits. Next, if a firm does not have a tax deduction and collection account number, TAN, it must obtain one before the deadline to avoid penalties. Firms must also put in place a proper system for TDS deduction and timely filing of returns. Additionally, it is crucial to inform partners about these changes so that they can plan their taxes accordingly. If any firm is unsure about compliance, consulting a tax expert is highly recommended to avoid legal and financial complications. The Finance No. 2 Act 2024 has brought two major reforms that will reshape partnership taxation in India: the increase in remuneration limits and the mandatory TDS deduction under Section 194T. While the higher remuneration cap is a welcome change, the introduction of TDS makes compliance more stringent. Firms must act now to ensure they are prepared for these changes and avoid any penalties or legal troubles in the future. If you found this video helpful, don't forget to like, share, and subscribe to stay updated on important tax and financial changes. See you in the next video.